Right, welcome back, boys. Let's talk Bitcoin. All right, so just in time for Halloween, we've got some spooky structure. As you can see, the daily's already getting fucked, so it needs some help today. But we got stock liquidity on both sides of the market. Pretty much anybody who's shorted inside the range has been tagged out on the move that we saw on Monday. Anybody who longed inside the range has been tagged out the move we saw today, or earlier in the morning. So we know where liquidity stands at this point. We know that it's very likely that, and you can check this on the liquidation heat maps. You know, if they longed it since last week on Wednesday, that move there just invalidated them. If it didn't invalidate them, then we know that their invalidations are likely at the low or resting below them. And again, the same thing can be said to the top side. Now, what's a little bit different between the top and the bottom side is this context over here. So there could be even more invalidations here. There likely is, right? And there's likely invalidations below this as well. So it's a little spooky, right in time for Halloween, to have all the clustered invalidations and liquidations on the bottom side, or at least more on the bottom side than the top, right? Because the next one on the top would have to be up here or up here. So based off of the movements that happened in the last couple days, you know, it's leaning towards a little bit more bearish, unfortunately. Doesn't mean it can't be saved, right? Doesn't mean there's a path forward for Bitcoin going higher, but as it stands right now, the structure is starting to look a bit spooky here, boys, unfortunately. So how do we take advantage of this? Well, we want to wait till people are invalidated, and then we want to see the imbalance of supply and demand, right? Pretty standard issue stuff. So if we go low, right, the question is, first off, how low? So do we go for these guys over here, or are we just going for pretty much the last week or so, the last week and a half? That's the first thing we want to see. If we go for just the last week and a half, meaning we don't tag these guys out or these guys out, and we see a bounce back into range, then there's an opportunity, right? Because what does that show you? It shows you that longs got liquidated and stopped out, but the price didn't take a nosedive. So the derivative market gets squeezed, but there's not enough sellers of actual Bitcoin to push the price lower. It was almost like a temporary move that happened because longs got liquidated and stopped out, right? And then we get to see if there's an imbalance of supply and demand. So we could do something cheeky. You know how like we have equal lows here? We could do something similar to that, depending on, you know, how much action we get. Since we're heading into a weekend, it could be less likely that we get a bunch of market participants to sell at the same time. But yeah, so we're going to see whether or not there's this imbalance of supply and demand. If there is, there's no opportunity, right? It just means Bitcoin goes deep diving. And then the level next for Bitcoin on the deep dive is, this is kind of an ambitious one, but it's sitting at 100K. And then the more realistic one, if all the structure breaks that we've been building pretty much since the beginning of summer, then the do or die level is at 89-90K. That's the do or die level because it's the very high time frame structure. It's where we saw in Q4 last year, all the invalidations, all the stop losses in the same spot. Price broke down, which provided liquidity for, you could call this accumulation if you want, but it provided liquidity, right? Because there's a lot of sellers doing the same action at the same time, which if you want to buy a lot of Bitcoin, provides you a lot of liquidity to buy it, right? When everybody's selling. So we can assume that bids started to get filled in this range. And now the question is, will that be defended? And so if we do hold this, accumulation is defended, structure looks beautiful, the fluidity looks beautiful, and we'll likely get a new all-time high sooner than later. If this breaks, we could be heading into a bear market. You know, the age-old 4-year cycles thing. You guys know I don't really care about the cycles, but in Bitcoin, it's usually up for 4 years, down for 1 year. Again, it's just because it happened in the past doesn't mean it's guaranteed to happen in the future, but it has happened pretty consistently. So it'd be interesting if it's still the same playbook. But I think we'll have our answer in a couple different ways, right? First, let's see what happens here. If this does even happen, but first let's see what happens here. If it goes for deep sea diving, then holding 90K is paramount, or the probabilities of us heading into a bear market in my eyes, starts to become more significant. Because you really don't want to go back here. You might do something cheeky like what we've been doing the last couple years where you make like an equal low or something, but then you got stack liquidity on the bottom side, resting right here where there was a resistance turn support. That's fragile as fuck. But I know most of you guys are more interested in what's going to happen in the near term, so again, if this does happen and we get an imbalance of supply and demand, there's not enough sellers of actual Bitcoin and the move is mainly from longs getting stopped out and longs getting invalidated, we start to revert back to the mean. We start gaining. We get maybe a daily close or two above these previous lows after wiping them out. Then looking for the retest of that to go for the top side liquidity, right? If we can go for the bottom side liquidity and we can hold it, then we're likely to go for the top side. And if we go for the top side, it lines up quite nicely at around the 118K level. So going for the top side liquidity, same logic. A bunch of shorts get squeezed out, so we get a flood of market orders in the a flood of market buy orders in the books on the derivative side, which will temporarily push up the spot price. So we get a temporary move on the spot market, and then the question is it actually temporary? So if we fail this, then we know that it's like the move is likely due to a squeeze on shorts, and there was an imbalance of supply and demand because of that squeeze on shorts. And so it's the same logic, right? And the beautiful thing about this is it's the same thing on the other side where you have where people, likely to start buying and flooding into the market. And then you can argue this was sort of like a distribution. And where is it likely to be defended if the price kicks back up at it, which is, where the sells or distribution started to get filled. So, you can look for the more cheeky approach, which would be just going for the wick on it, which is around 117.9 all the way up to 118. Just call it 118, it's a cleaner number, but more specifically, it's 117.9. And then if you want to go for a little bit more of a safer approach and you're not trying to catch the top, then you'd sort of look for the retest of these highs. Because you can argue that that's where it'll be defended on the more local structure on Bitcoin. So that's more of the passive approach, right? It's a little bit zoomed out, and it might take a day or two before these plays sort of come to fruition. I mean, it might take longer. You guys know I don't like to time the market. It depends on what the market wants to give us, right? If it wants to give us big action and wants to give us volatility, then we get a lot of opportunities. If not, then we got to get a little bit cheekier with it in order to get filled on some other stuff. On the sell side of the book, right? Where were areas where liquidity had a consensus? Because as you can see from the orders rolling in on the right over here, it's always kind of a mixture. You got some buyers, you got some sellers at pretty much every level. Every once in a while you hit a certain spot where it's all sellers or majority is sellers, or a certain level where the majority is buyers. It's usually going to be extremities in the data set. So like, where do you think invalidations were in this little micro range for longs? Same thing here, and same thing here. So these are sort of areas you want to take look at for the more aggressive scalping. Again, it's going to be lower probability because the time frame's lower, and the best case scenario is holding it in this green box, because if we go dive down here and do something like that, then we've got stack liquidity, right? Then we've got anybody who long this move up will have been invalidated except for the people at the lows here, and they'll be sharing the same invalidation. So same thing that we saw in the higher time frame will be applicable in the lower time frame, and usually it's not really ideal if you want to long something. And the other risk that you run is the slippage, right? If you do go for this one and it works out, which it might, your stop loss is going to be near the lows where everybody else's stop losses have already been placed. And so if this thing does nosedive, you're going to be paying slippage on it as well. If you're on a big account. If you're on a small account, it doesn't really matter too much, but so just keep that in mind. The perfect scenario for the bulls today is actually holding it here. That way we don't stack up any liquidity on the bottom side. But because, the markets have been pretty brutal lately, the VIX is kicked up, the S&P is kind of struggling a bit. We could go deeper. But on the other side, you just look for stack liquidity. So we got some fragile bear market structure here. You've got, a bunch of invalidations. So if they shorted since yesterday on Bitcoin, they likely also got invalidated on this move right here. So invalidation should be at the highs or above them, right? So we know where the short sellers on the local are sort of posted up. there's not really too many opportunities to short unless you want to get really aggressive with it, because we've already dumped a pretty good amount. If you want to get really aggressive with it, then you're looking for the same thing on the inverse where this sort of distribution happened. And there's more room to breathe for the bears here. So the aggressive play for shorting, and I'll make this box red, is here. Just keep in mind, guys, this is... I know I've said it multiple times now, but it is important to remember. These are lower probability. It's lower time frame. We don't really have high time frame confluence to work with here. The longs, you can kind of argue we do because we're at the bottom of the relative range. And the price action has been really loving holding equal lows and equal highs lately. As annoying as that is, that's sort of been the play for the last year and a half or so. So longs kind of have high time frame confluidity going with them, but not the shorts. So shorts are a little bit more aggressive. Longs are a little bit less aggressive, but both are just probabilities, so make sure you use good risk management. Alright, I'll leave this up on, just if you guys are curious why these levels are where they are on the short side, it's the same thing as the long side. Where do you think short sellers got squeezed out of their positions? Meaning, where do you think there was buy liquidity on the in the derivatives? So shorts getting validated, obviously they're going to operate as a market buy. A bunch of market buys hit the derivative books at the same time, which provides liquidity for people to get short. And where do you think those people who got short are going to defend? Likely where they started to get filled.